Every few weeks, the world's most powerful financial institutions gather behind closed doors. No television cameras, no campaign speeches, no dramatic votes in parliaments. Just economists, charts, and models. And one deceptively simple question: should we hike rates or drop interest rates? This year, something unusual has happened. Across much of the developed world, central banks have chosen to stand still, not because inflation has been defeated, not because economic risks have disappeared, but because the world has become far more uncertain. From persistent inflation and resilient labor markets to escalating geopolitical tensions in the Middle East that threaten global oil supplies, policymakers are weighing risks that could quickly push prices higher again. A surge in energy costs would ripple through transportation, manufacturing, and household expenses, potentially reigniting inflation just as it appears to be cooling. So rather than declare victory too soon, central banks are waiting to see whether inflation is truly under control or merely catching its breath before the next shock. And that could determine where stocks, bonds, currency, housing, and your own investments go next. Imagine trying to steer the world's largest ship through a thick fog. Turn too early and you might hit an iceberg. Turn too late and you miss the safe channel altogether. That in many ways is what today's central bankers are facing. Only instead of steering one ship, they are steering an entire economy. After one of the fastest global interest rate tightening cycles in decades, inflation has cooled substantially from its post-pandemic peaks in many advanced economies. Yet, despite this progress, the world's major central banks have become remarkably cautious. The US Federal Reserve has kept policy rates unchanged in recent meetings. The European Central Bank has paused after raising rates in June. The Bank of England has also held steady. Meanwhile, the Bank of Japan, after finally exiting years of ultra-loose policy, is proceeding with extraordinary caution. On the surface, this might seem strange. If inflation is falling, why not simply cut rates? After all, lower borrowing costs usually encourage spending, investments, and economic growth. Economics rarely works in straight lines. In fact, the greatest danger for central banks today may not be inflation itself. It may be declaring victory too soon. History has taught policymakers an uncomfortable lesson. Inflation has a habit of pretending it's gone before quietly returning. In the 1970s, central banks relaxed monetary policy prematurely after inflation appeared to ease. The result wasn't lasting relief. It was another wave of inflation that ultimately required much higher interest rates and deeper economic pain to bring prices under control. Today's policymakers remember that history, perhaps better than anyone else. And that's why phrases like data dependent, meeting by meeting, and higher for longer have become some of the most repeated words in global finance today. They aren't trying to sound mysterious. They are trying not to repeat history. But here's where things become even more fascinating. Although many central banks are making similar decisions, they are doing so for completely different reasons. The United States worries about a resilient labor market. Europe worries about energy prices and geopolitical shocks. Japan worries that inflation might finally be becoming permanent after decades of deflation. If you look at China faces almost the opposite challenge, stimulating demand in a weaker economy while maintaining financial stability. Now we have different problems, different economics, yet remarkably similar caution. It's almost as if 9 different doctors are treating 9 different patients and some are prescribing the same instruction. Let's wait a little longer. That shared hesitation matters far more than most investors realize, because interest rates influence almost every financial decision on earth. How much companies borrow, whether families buy homes, how expensive government debt becomes, whether investors choose stocks or bonds, even the value of currencies, and increasingly the direction of cryptocurrencies. One decision by a central bank can ripple through thousands of markets, affecting trillions of dollars within minutes. And that's exactly why this story deserves more than headlines about rates unchanged. Behind those two simple words lies one of the biggest investment stories of the decades. So, why is nearly everyone waiting? To understand today's pause, we first have to remember just how extraordinary the last few years have been. When the pandemic struck in 2020, central banks did something unprecedented. They slashed interest rates close to zero. Many launched enormous bond buying programs. Government introduced historic fiscal stimulus. The priority wasn't controlling inflation. It was preventing economic collapse. And initially it worked. Markets recovered, consumers started spending again, businesses reopened, but then something unexpected happened. Demand came roaring back faster than supply. Factories couldn't keep up. Shipping costs exploded. Energy prices surged. Labor shortages spread across industries. Then came geopolitical shocks that pushed food and energy prices even higher. Inflation has accelerated almost everywhere. Suddenly, the biggest problem had become exactly the opposite of the one policymakers had been trying to solve. Money had become too cheap. Demand had become too strong. Prices were rising too quickly. Central banks responded one of the fastest synchronized tightening cycles in modern history. Interest rates climbed across North America, Europe, Asia, and many emerging markets. For businesses accustomed to borrowing cheaply, it was like waking up in a completely different financial world. Imagine running a company where your loan costs suddenly double. Projects that once looked profitable no longer make sense. Hiring slows down, your expansion plans get delayed, your investments become more selective. That's precisely the mechanism central banks wanted. Higher interest rates are designed to cool demand, not by forcing people to stop buying, but by making every financial decision a little more expensive. Eventually, slower spending reduces inflationary pressures. It's a remarkably effective tool. But it comes with an important catch. Interest rate changes don't work instantly. Economists often describe monetary policy as operating with long and variable lags. Think of steering a massive cargo ship. You turn the wheel today, but the ship changes direction much later. You raise rates too aggressively, and you might discover months later that you have slowed the economy far more than you intended. Cut them too early, and inflation could return before you even realize demand is accelerating again. That's why today's central banks are behaving less like sprinters and more like mountain climbers. They have already completed the steep ascent. Now they are carefully checking every step before beginning the descent. And the latest decisions illustrate exactly that philosophy. The Federal Reserve has maintained its target range while emphasizing that future decisions depend on incoming economic data rather than a predetermined path. The European Central Bank likewise has held rates steady after its June increase, stressing that policy will remain data dependent as officials assess inflation risks linked to energy prices and broader economic uncertainty. The Bank of England has also kept rates unchanged despite inflation moving closer to target because policymakers remain concerned about persistent underlying price pressures and external risks. Meanwhile, Japan tells a different story. For decades, its central bank struggled not with inflation, but with prices rising too slowly. Today, after finally moving away from negative interest rates, the Bank of Japan is holding steady while signaling that underlying inflation may prove stronger than previously expected. A remarkable reversal for a country once defined by deflation. So despite different economic conditions, a common theme emerges. Nobody wants to be the first to make the wrong move, because monetary policy isn't judged by what happens tomorrow. It's judged by what happens 6, 12, or even 24 months later. And that's where the real uncertainty begins. Inflation has slowed, but not every source of inflation has disappeared. Labor markets remain tight in some economies. Energy prices remain vulnerable to geopolitical shocks. Trade tensions continue to reshape supply chains. Artificial intelligence, AI, is boosting productivity in some industries while increasing investment demand in others. Every new economic report has become another piece of an enormous puzzle. Central bankers aren't simply asking, is inflation lower? They are asking something much harder. Will it stay lower? And until they are confident about that answer, waiting may be actually the safest option. So if central banks are waiting, investors certainly are not. Every speech, every inflation report, every employment number, every press conference, markets react almost instantly, sometimes within seconds. And that raises one of the biggest questions in finance today. If interest rates stay higher for longer, who wins? Who loses? And where should smart investors actually be looking? That's where our story goes next. I need you to imagine 6 athletes standing on the same starting line. We have a sprinter, we have a marathon runner, we have a swimmer, we have a cyclist, we have a weightlifter, and we have a chess grandmaster. Now imagine changing only one thing: gravity. Every one of them would react differently. That's exactly what interest rates are. They are the financial world's version of gravity. When rates rise, gravity becomes stronger, borrowing becomes harder, risk-taking becomes more expensive, cash suddenly earns a respectable return, and investors begin looking at every asset through a completely different lens. The world's major central banks have now spent months holding that gravity almost perfectly still. The question investors are asking is no longer, when will raise rates? It's also not, when will they fall? The question is, what does a prolonged pause actually mean for our money? Let's start with one of the world's largest asset class, stocks. Now, for most companies, interest rates influence one number above all else: the cost of capital. Think about a technology company planning to build a new artificial intelligence data center. If borrowing costs remain extremely low, that investment looks attractive. But if financing becomes much more expensive, management has to ask much harder questions. Will the project still generate enough returns? Should the expansion wait? Should cash be preserved instead? This is one reason why higher interest rates tend to slow corporate investment. But something interesting has happened during this cycle. Despite elevated borrowing costs, many large companies continued producing surprisingly resilient earnings, especially firms with strong balance sheets, healthy cash flows, and pricing power. Markets gradually realized something important. Not every company suffers equally when rates remain high. Businesses carrying heavy debt loads often struggle. Companies generating abundant cash flow frequently adapt much better. That's why investors increasingly focus on quality rather than simply chasing growth. Now, the era of money is almost free encourages investors to reward almost any exciting story. Today's environment rewards profitability, consistency, and financial discipline. The days of easy money has given way to the era of expensive capital. Now, if stocks are the celebrities of financial markets, bonds are the revered old politicians. For more than a decade after the global financial crisis, many government bonds offered historically low yields. Some even produced negative returns after inflation. Today, the picture looks remarkably different. Higher policy rates have restored income to fixed income investing. Government securities, investment-grade corporate bonds, high-quality money market instruments, they are once again competing with equities for investors' attention. Imagine receiving a relatively attractive return simply by lending money to a government. Suddenly, the hurdle for investing in risky assets becomes much higher. This explains why financial markets pay extraordinary attention to every central bank meeting. A single sentence suggesting rates may remain elevated can move trillions of dollars across global bond markets within minutes. That's precisely why bond investors have become some of the most attentive listeners on earth. They aren't just watching inflation, they are listening for tone, for nuance, for hesitation, because today's bond market is trying to answer one enormous question. Have yields already peaked, or are they preparing for another climb? As of late July 2026, the European Central Bank kept rates unchanged while stressing that decisions will remain data dependent because energy price uncertainty and second round inflation risks remain elevated. Now, one of my favorites, real estate. Real estate often feels interest rates far faster than almost any other sector. A 1% increase in mortgage costs can dramatically change what families can afford. That doesn't simply reduce demand, it reshapes entire housing markets. Developers delay projects, investors recalculate returns, home buyers reconsider budgets. Commercial property faces another challenge altogether. Remote work, changing office demand, refinancing expensive debts. Properties purchased during years of ultra-cheap financing now face renewal at much higher borrowing costs. Some adapt successfully, others don't. But history also reminds us of something important. Housing rarely moves in one straight line. Supply shortages, population growth, income trends, government policy all continue influencing prices alongside interest rates. That's why real estate markets around the world have become increasingly regional rather than moving together. Now, for the biggest market in the world, currencies, forex, foreign exchange. Currencies may appear mysterious, but one of their biggest drivers is surprisingly simple: relative interest rates. Money naturally seeks attractive returns. If one country offers substantially higher yields than another, global capital often flows towards those assets. That demand can strengthen the currency. But here's why today's environment becomes fascinating. Most major central banks are pausing at roughly the same time. That reduces the enormous policy differences that often drive foreign exchange markets. Instead, currencies become increasingly sensitive to expectations. Who cuts first? Who waits longest? Who surprises markets? Even subtle changes in guidance can move exchange rates within seconds. Japan illustrates this perfectly. For years, its ultra-low interest rates encouraged investors to borrow yen cheaply and invest elsewhere. Now, the Bank of Japan is cautiously moving towards more normal policy, yet it continues proceeding gradually, keeping its benchmark rate unchanged while signaling that inflation dynamics are evolving. Foreign exchange traders know that sometimes the biggest moves begin with the smallest policy changes.